This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here, host of the Smart Property Investment Show. Hope you're well. Don't know how you're going through this current property market. A lot of noise out there. I'm sort of get involved a fair bit these days talking about property. For some reason, people think I know what I'm talking about, which if you've known me long enough, you probably know is a bit of a fallacy. What I am pretty good at is talking to people that know a lot about property. So my job really is to get them in the studio, have a yarn with them, work out what's going on, and hopefully you can make more informed decisions as you continue or embark on or conclude your property investment journey. We're all watching, and if you've been tuning this for some time, you know that I have quite a large property portfolio. I'm watching the cost to hold my property portfolio go up by the month. I'm sick of getting letters, still snail mail, printed in an envelope through the post telling me each time there's another 50 basis point increase to my interest on my mortgage repayments. And when you've got a few mortgages, those letters start loading up, and now I just throw them straight in the bin because I know what they're going to say. But if you're not getting those letters, guess what? Your interest rates are probably going up. So if I were you, I'd probably be checking in on your online banking right now to actually understand what sort of interest rate you are paying and whether or not you can handle that, whether you can buttress from a cash flow point of view, and whether or not you need to do something about it. Maybe speak to your mortgage broker and see if you can get that stuff refinanced. But there's a lot of strategies, a lot of tactics around this. And this is an environment we're going to be in for some time. Already you see a lot of the banks sort of longer term fixed rates products are coming down. So at a point in time, this is a rate cycle that will go up. It will come down again, like the grand old Duke of York. And I'm personally sort of speaking to a whole bunch of people to work out what I'm going to do about it, how I can support better cash outcomes in portfolio now. But more importantly, I'm still relatively young. Keep cracking it, building my portfolio and that wealth creation journey moving forward. One person I get into the studio quite regularly, I've got a few years on him. He's been at it for a little while though himself, now in the seat at Henderson Advocacy, henderson.com.au. It's buyer's agent, Jack Henderson. He's back, he's joining me, and I'm going to pick his brain, what he's doing, what he's advising his clients to do, and how you can learn from something and potentially not have to pay for it. Jack, how you going?
Good, mate. Well, I heard the entry was, you get people on here that know a little bit about property. And I thought, mate, I'm in the wrong studio.
Still learning. But it's funny, right? But, right. You know a bit, and, I know a bit as well, but I still learn every day. And I use these as opportunities to learn, and always like catching up and seeing what's going on. You got a particular way of doing business, and you got to spring your step, and no doubt a lot of people see you on social media, and I know you got a growing client base of happy people who are sort of connected in with the Henderson brand, henderson.com. I saw that when I was researching for this. It's a good URL to get.
That's a very good. I was just saying it'll be $1 billion URL one day. It cost me $10,000 to get a hold of. So, mate, the ROI on that will be very, very good.
Yeah, and for those of you who are seeing this on the social media, on the interweb, it makes me a bit nervous. We've got a videographer. Do I get that right?
Mate, yeah, the main man, Matt Champion.
Matt, he's there. We're getting filmed right now, and hopefully most of the stuff is of you because people want to know what you've got to say rather than me sort of droning on with a nasally voice in the background going, oh, yeah, what does all that mean? But what's been happening, I hear that you did an interview this morning with a newspaper around property. Was that just a warm-up for today's chat, getting you in the mood? What were you chatting about?
And I got the voice cords warmed up. Actually at a Bucks party on the weekend, so I'm still recovering from that. Mate, yeah, I guess because I do have, a lot of content, and I'm constantly putting out my thoughts and my expertise, as you'd say.
Yeah, just inverted commas. That means it's not real.
Yeah, well, it's my reality of what I think. Whether people agree with it or not doesn't really matter as long as it works for myself and my clients. But mate, yeah, I've obviously got a lot of media people, whether at the AFR or Sydney Morning Herald or Newcastle Herald.
Yeah,
always wanting to know my thoughts and opinions and what's happening and what are you seeing, what are your clients doing. So this morning's interview was about timing the market and, should people be buying now or should people be waiting for the impending crash that, everyone keeps talking about? Should people keep waiting for interest rates to increase before they buy? So I just, told them what I thought.
Give them your thoughts. Which is, and having worked in the media for a while, they like quotable quotes, and no doubt you'll be able to give them a nice quotable quote. Well, what's your, sort of in jest saying, I don't really know a lot about property. I know a fair bit, right? And I guess by trade I'm a journalist, so I like to think I was one of the more informed journalists around when it comes to property. In your dealings with sort of other media outlets and papers and stuff, do you reckon, is there a baseline understanding for most journalists about property, or are they mainly about, we hate property investors because property investors rise prices and therefore I can't buy a home and they price me out of the market? A bit more left-leaning thoughts?
Look, mate, I think at the end of the day, everyone has a job to do, right? Journalists' job's to grab attention. There's a lot of competition in that world. So usually they've got a vested interest in spinning the story one way or another. So, a lot of the questions journos ask are generally, they're leading questions. They want a certain answer. And if you don't give them that answer, they'll continue to ask until they get something that comes close to that answer. But look, again, whether they're pro-property or against property, I'm a big believer in, every bit of media is good media. So
that's a very diplomatic response. You saw it there. But let's have a chat about it. So the basis of the discussion today was about timing the market versus time in the market.
That's right,
so in and out versus how long. And it's property 101, right? Like a lot of people talk about it. And this is going to, for your average sort of punter reading the paper, they might go, oh, yeah, that sort of makes sense. Smart property investment shows for property investors, probably a little bit more sophisticated, but that's like 101 type stuff. And how did you respond to that? Did you give them something topical? Was it time in the market rather than time? You folly to try and time the market?
Well, a lot of the questioning was around timing the market. Should people be buying right now or should they be waiting? And, my answer is the same as it always is. It's like, well, I don't know what's going to happen tomorrow. And if anyone does, please put them in contact with me because I'll hire them. But the reality is, like, I'd rather bet with history than against history. And history shows us that over the last 150 years, Australian property has done 6.5% compounding. So, I'd rather bet with that. So what happens tomorrow, next month, next year, it doesn't really matter. What matters is, what's happening over the next 5, 10, 15, 20 years. So if you've got the financial capacity to buy right now, you should buy right now because who knows what's going to, in a year's time, you may not have that capacity. You may be in a completely different circumstance. You might have a different mindset. So I don't like leaving things to chance. I like, being an action taker. And I think in this world, action takers are rewarded.
It's a good point. And that's a very safe answer, but I think it goes to show that, and I've spoken at length about this over many years, property's not hard, right? Like a lot of people overcomplicate property and make it very, very difficult. But what you're saying there is going time in the market, timing, ING, the market. You're never going to win it.
It doesn't
You're
work.
never going to win it, right? Like you're either going to go too soon, too late. And if you miss a market by 1 month, 2 months, 5 months, a year, the ramifications of it isn't that considerable, right? You might not get as much capital growth as what you should have done. But your point is that if you can invest in property, any time's the right time to invest in property. So don't get absorbed or obsessed by timing the market, because what typically happens that I've seen, and I'd like your thoughts on this, is that people just don't do anything. They just sit there waiting.
That's all it is. It's not just property. It's everything in life, right? Oh, I'm going to start that business. I'm going to get that new job. I'm going to break up with my partner. Whatever it is, it's always we'll wait for the right time. We'll wait for the right time. We'll wait for the right time. And, when you're waiting for the right time, life passes you by. So, I'm a big believer in just doing things and then working out what the ramifications of those doings were, later down the track. Which
I guess, it could be a property discipline. It could be a business discipline. It could be a personal discipline, right? Backfilling. You backfill, just do it, and then it might not be perfect, but you can backfill behind you.
Perfect is a perception, right? It's your perception. What your perception of perfect is very different to someone else's perception. So, a lot of people won't produce content because they're worried about the perception of someone else. Oh, it's not perfect. But does it really matter? Does it really matter? It doesn't matter. No, it doesn't.
Most things are quite forgiving, and I guess talking about content, if you're unique and organic and you stay true to yourself, people want to know, and hence the reason why you're sort of quite popular. But, to this point around perfection, this sort of adage, and I'm sure you've heard it, which is imperfect action trumps perfect inaction. And a lot of people use that in business, but within the context of property, imperfect action means you're taking action, but it might not be absolutely perfect. And you're talking about, is it time in the market? Is time in the market right now the perfect timing? It doesn't really matter, sort of give or take either side of it. But if you embrace the idea about imperfect action, as in you're doing something, but still you can fundamentally be doing the wrong stuff, right? You're like fundamentally buying the wrong type of asset, the wrong property in the wrong area. When can you really start finding yourselves in, dire sort of by taking action, but the wrong action? What would the wrong action be for you? Yeah,
the wrong action would be buying the wrong property in the wrong location. Because it doesn't matter how long you hold that thing for, the performance of it's likely to be, quite dire. And a lot of people face that. Like most people know my story. My parents faced that. And the issue with property is you don't know until you've held it for 3, 4, 5 years, right? You buy a business or you buy shares, you know within 12 months, right? Like whether that business is doing what you thought it was going to do or whether it was not doing what you thought it was going to do. With property, it's very hard. You're not valuing that property on a daily basis, right? If you've got tenants in there, they're paying you rent, you're not really noticing the impact. You're not an aggressive investor, so you're not trying to refinance and buy again. You might wait 2 or 3 or 4 years, then go back and refinance and go, oh, it's gone backwards, or oh, it hasn't done anything. And, that's when you start to have the realization that you've bought the wrong property. And then most people don't want to solidify that either because you don't feel the loss until you actually sell. Yeah. So people go, oh, we'll just hang on for a little bit longer. Opportunity cost comes. And my parents did that for 11 years with a property of theirs. Hence the reason I'm so passionate about, buying the right property and the right location. So yeah, that's the most important thing. And I think a lot of people have done it over the last couple of years as well, because if you bought a property, nearly any property over the last 2 years, due to things that have happened outside of any of our control, which was the quantitative easing that was put into the global economy, asset values have increased substantially. And not by not being a good investor, by just things that have happened. And a lot of those people now, I think over the coming years, as interest rates rise and that liquidity gets sucked out of our economy, they'll start to realize, wow, we maybe bought the wrong property, or maybe it's not as good as we think, or maybe the valuations aren't as good as they were 2 years ago.
Yeah. Oh, I want to chat through some of those strategies connected with what you just said, but just in general, how's business going? Like, we're in a rising rate environment. There's a lot of concern in the market. Mm-hmm. Is the bubble going to burst? Again, they've been talking about it for years. Is there still a lot of appetite for property investing? Are people still going, hey, look, I want to get into this. This is right for me. This is the asset class for me.
Mate, I'm always honest. May and June, it's pretty scary. A lot of people went, what is going on? Sitting on our hands, doing nothing. Naturally, our business relies solely on property and my portfolio relies solely on property. So, we made some significant changes. July come around, we had our biggest ever month of onboarding new clients. Now in August, and we'll top that. We've got 1 day to go and we'll top our biggest ever month of onboarding clients. So we had 2 months of pretty average numbers, not doing a great deal. And that was just, the transition. Yeah. You think back to when the Royal Commission happened, very, very similar. But now I think it's normal, right? People go, this is an opportunity. It's not the end of the world. Our client base transitioned from being very owner-occupier focused last year to now very investment focused. And, now we just continue on. So business is good, but it was not so good for a couple of months for sure.
And that's that mindset jitters that people get when there's change. If you think back to, February, March 2020, April 2020, when COVID first hit, it was like Armageddon with the banks saying, 40% decrease in property. Everyone just stopped. And then eventually they went, oh, okay, should be all right. We've got a bit of pain ahead of us, but let's keep moving on. And we had the price increases like, it's most I've seen in my investing journey, no doubt, like yourself. So, this change is always tough. Change of government, change in interest rates, start going up, all this sort of stuff. People go, oh, what's happening? And then they work out, probably going to be okay. Balance sheets, family balance sheets are strong. Interest rates are all-time lows. They're still below the average of what they should be. Now they're getting up there now. You're probably paying, you've probably got an interest rate with a 4 in front of it at a variable rate right now. If you just got something, maybe 5%, depending on what you've got. So this is a normal environment, right? This is not like when I bought my first high property, interest rate environment.
It was about 4.8, I think it was when I bought my first property. So we're back to those levels.
That's it. And there's a long time bet in property. As you said, 100 odd years of it. 6.7%. So how it goes.
Not bad.
So do the math.
Then you got a yield on that as well. So you're probably, 3.5%, 4% yield on a property, 4.5%, 5% interest. You're probably negative by 1%, 7% compound growth on that. Not bad.
It's okay. Well, let's get into that. Let's go to a quick break. Stay with us, everyone. Back in a moment.
Throughout 2022, we've already seen a huge ebb and flow in the Australian housing market. Property prices increased earlier in the year, but the rate hikes have slowed down price growth over the last few months. Even so, we've seen more new listings hitting the market than we've experienced in recent years. Plus, with many property owners having accrued a significant increase in equity, the market is hot for investors looking to snap up another property that may have reduced in price. To help you find these properties, the team at Pure Property Investment have done all the legwork to identify the top 30 suburbs that have not only shown growth throughout this year, but are also poised for strong capital growth over the next few years. Grab your free top 30 guide to property investment investment guide today at www.purepropertyinvestment.com.
Welcome back. Phil Tarrant, host of the Smart Property Investment Show with Jack Henderson from Henderson Advocacy. You know, I struggle with the word advocacy. I struggle with a couple of words. Advocacy is one of them, and realtor, which is an American term.
It was actually Henderson Acquisitions when I first started, and then my marketing people said, make it advocacy. I said, yeah, okay, you're the experts.
Advocacy is good. But what does being an advocate mean? You advocate for them, right?
That's right, yeah. And Henderson will be, a group of companies as well, so it won't just be the buyer's agency side of things.
You got any details there? What's going to happen? Or is that you've got to keep them pretty close?
No, so we've started the development side of the business.
Oh, very cool.
Which won't be accessible to clients as such. It's more a personal thing with some funding partners. So that's
like resi developments?
Yeah, we'll start off as resi, duplexes, townhouses, and then, my goal is to build luxury apartments all around the world. So
pretty cool.
Mate, that's the goal.
Yeah.
Yeah, that's why I'm not too
flying at the front of the plane.
We fly there.
From place to place.
We fly there already.
Yeah. That's are you already doing stuff or you're looking at that?
Yeah, so we got the site in Paddo, which is where our office is, which we're redeveloping, and we're looking at 2 more acquisitions before the end of the year. A lot of opportunity in that space at the moment.
Are you sort of nervous and, developments at all levels, from massive high rises like, Atlassian's building that huge tower in Central, right? That's one level of development, that's commercial development, all the way through to sort of mum and dad sort of building a duplex. What's your concerns with the development environment in terms of access to funds, access to tradies, access to materials, increasing costs? Is it going to normalise? You must be backing it because you're investing in it.
Yeah. Again, it's short term, like building costs have increased, sure, but you just got to build them into your overall margin of your development, right? If you're doing feasibilities on building costs in 2018, then you're probably not going to make any money. But, if you buy a site that has building costs that are relative to today's environment and you have a, projected sale cost in that is quite conservative, then there's still money to be made for sure.
Yeah. And have you got anything coming out of the ground now or? Nothing
out of the ground. I just got a DA approved actually, but it hasn't started building yet.
Okay.
That's a personal property.
Yeah.
But by, I would say, December, January, there'll be stuff starting to come out of the ground.
Yeah. Have to come back and tell us all about it. You mentioned something beforehand. We're talking about how property's long-term play, 6+% capital growth year on year. You look at the arbitrage of, what you're paying for your mortgages versus the capital growth you're getting. And ideally, you're ahead of the game. That's why most people invest in property. But we're at this sort of cycle right now where you haven't seen the narrative around it yet too much. We're in a rising rate environment. So a lot of people, typically more property sprinkles, will be in the market talking about sort of, positive cash flow, guaranteed positive cash flow, based on sort of like depreciation, all this sort of stuff on new properties. And if you dig down in the numbers, a lot of times you go, these aren't feasible investments, right? They might sound good from a marketing point of view, but when you look under the hood, you go, I'm not going to go near that at all. But I just want to get into this idea of like negative and positive cash flow as a strategy. A lot of people go, yes, my strategy is my accountant told me to use a strategy of, I'd be negatively geared rather than positively geared because I get a tax deduction on it. Where do you sit on this discussion?
Yeah. Whether you're positively cash flowed or negatively cash flowed, neither of those things are a strategy. Like, it's just a tax outcome. So, if you buy a property that's positively geared, you'll be paying tax on that cash flow, right? It's a tax outcome. Interest rates increase by 2% on that positive cash flow, and you may now be negative cash flow on the same property. So again, it's not a strategy. It's what happens when you go and see the tax man. And you could have a negatively geared property on, when you do your numbers, but then when the tax man's finished with it, you've actually gained some cash flow because of all the deductions and, what goes on. You could be in a positive position. So, I'm a pretty big advocate for, not worrying about positive or negatively cash flow. It's all about net numbers. So what's the property grown by in 12 months, 24 months, 5 years, 10 years? What's it cost you out of your pocket, both net and gross? And then what's your net number? That's the only thing that matters. Yeah. And then it's cash on cash returns too, right? It's not, I look at it from what did I actually put into this? Like you would, if you're brokering a business deal or you're brokering any other deal, you're not looking at the lending amount and what you made on that. You're looking at what your cash invested is and what your ROI on that cash is. So, it's very hard to beat property. Very, very hard.
We've got one of the reasons why we sort of built a portfolio inside of Smart Property Investment was to be able to talk about this stuff in a real world published environment. And our cash-on-cash return on that portfolio, and I'm sort of doing a lot of updates on it at the moment, but just on this particular point, I think we got that portfolio going in 2012, call it, 2011, 2012, I can't remember exactly. We put about 250K into it to get it going. Mm-hmm. Now it's, I don't know, $9 million or something like that. It's good portfolio. We pulled that original cash out probably in about 2015. So the thing that this portfolio owes us nothing. So our cash-on-cash return is
infinite,
right? Which is a really nice place to be. But, so it's really hard for us to measure cash-on-cash return on it because we've taken everything back that we had. So it's just a free pass on everything. I don't know how much equity is in that portfolio. It's probably about, I don't know, $4 or $5 million, right? That's not bad going for no capital outlay over a period of time, right? It's like $1 million a year pretty much.
20x your initial investment.
Yeah. And it's great. And hence the reason why, And
what people don't see with that is like if you put $250K into Tesla, to get 20x returns, that business has got to 20 times.
Yeah. It's hard, right?
It's almost impossible unless you're getting into seed funding.
Mm. Well, we've gone to the moon again. You see that yesterday?
Yeah, I did see that. NASA launched,
cool. Yeah. Wow. Crazy stuff. But anyway, I guess you want your property to rocket into the stratosphere, right? And but it's sometimes a bit of a myth, right? Like there's 10 years that's taken for that to happen. But, if I said to anyone, do you want to sort of realise $1 million in equity for nothing over a 10-year period, so $500,000 a year, I can't imagine many people go, nah, I don't want that.
Yeah, exactly.
I don't want that at all. But you've got to be strategic and diligent. And back to the point, you've got right asset, right time, in the right place. Now, that's it.
And be an action taker, right?
And be an action taker. But not, if I had my time again on that portfolio, I would have probably bought twice as much stuff, right? Because I could have, but I didn't. But, the point is you've got to get stuck in. You've got to take the action. You've got to be bold enough to do it without sitting on your hands around it. But now I look at that portfolio and I've spoken a lot about it. It is negatively geared, right? There's 18 properties in this portfolio. Would I rebuild a portfolio like that again? A lot of headaches in there, right? And managing it is a pain. But it's negatively geared. Like each property costs.
When you say managing it's a pain, is it because you'd rather have less properties at higher dollar value?
Well, it's one of those things. It's a good portfolio because they weren't at the higher level of the market, but they've been superly high performing properties. The aggregate of them means that there's a lot to manage. So I wouldn't change it at all. But it's a baseline portfolio that's helped propel us into other sorts of assets moving forward. So it's really just a starter portfolio to get going. And then once you've got enough properties and you start generating good sort of capital growth out of it, and you can use that to manipulate and pull money out and deploy it elsewhere, it's propelled us into the type of assets that we want to be buying, which we're absolutely doing right now. But it's negative. It sort of costs about somewhere between $2,000 and $3,000 a year to hold those properties before tax, right?
$3,000 a year.
Yeah. Yeah. It's not a lot, right? The big scheme of things.
Mine cost me that about a week.
But when you bundle it all together, it's at a negative level. And I'm trying to, this is a portfolio for the idea of it is an example for most Australian investors, what they would be buying.
Yeah, but $2,000 or $3,000 a year to hold 18 properties.
No, per property.
Oh, per property.
Per property.
Right.
Yeah. So it's
costing you about $500,000 a year to hold.
No, it's about $3,000 per property times
per
20.
year. Yeah,
yeah, it's about call it 70.
$70,000.
Somewhere between 70. But the reason why is that they're all in trust, so there's heaps of
no land tax exemptions,
all that sort of stuff. So it's cost the whole, but it's cost the risk it, right? But you've got to be comfortable with that. But we don't get obsessed with it being negatively geared because it's given us I don't know how much growth on it. How many people come to you and say, "Oh, Jack, I want a negatively geared property strategy. Can you go and find me some assets?"
No one comes and says that. Everyone says, "Hey, Jack, I want a positively cash flow property." And I say, "You come to the wrong person, son. Go and see someone else."
So what happens? Yeah.
Yeah.
But you sort of buy at a particular,
we buy things from $400,000 or $500,000.
Yeah.
But they're still negative. They're not positive, because the yields are reflective of that. Just because it's a lower dollar value doesn't mean the yields are higher.
Yeah.
They're still 3.5% to 4.5%. But majority of people out there, go, "I want a positively cash flowed property. I want to be generating income every week, every month." Yeah.
Why do they come asking for that, do you think?
Because, there's a lot of companies like ours out there, and it's much easier to have a strategy that sells to the mass market. Because you can say, "Hey, I'll put money in your pocket every week and I'll get you capital growth and we'll get you 10 properties." There's a lot of bull out there, a lot, So if I had a business like that, we'd be 10 times the size of what we are right now.
Yeah.
Because you've got so many more people.
So how hard is it to get a positively geared property in this market for most?
Oh, not really. Investors. Go and find the most regional location. You can go buy in Perth, go buy in regional Queensland, You can easy to find a positively geared property.
Go back of Broken Hill, right?
Yeah.
You get 8-9% out there.
The only thing I say to people is no worries. Like, we're not the company for you. If you want to find a positively cash flowed asset, you need to go find someone else. But ask yourself this one question before you buy the next property. If someone's willing to pay you more to live in that property than it costs you to own, there's a reason for that.
Let's break that down. Why?
Well, if someone's willing to pay you more to live in it than it costs you to own, there can only be a few reasons. One is because they can't afford to buy it themselves. So they're forced to rent, lower socio-economic. Could be in a location where people don't want to buy. Reason mining towns have such high yields because people don't want to buy there. It's short term. They're in huge demand for rentals in the short term. Job finishes, they bounce. That's why all the growth hasn't been able to keep up with the rental growth.
There you go.
All three of those are worrying.
So sometimes if people are out there hunting positively geared properties at a, not sort of like a break even, like at a substantial positive, sometimes there's hairs on the property. A lot of the times there's hairs on the property.
What we like to do is we will buy an asset based on the asset itself. We don't care about the cash flow. We want to buy the asset based on its fundamentals, and we can manufacture it to be positive by adding a second dwelling to the property, for example, by redeveloping that property, for example. There's many things you can do to an asset, an existing asset, to make it positively cash flowed, to generate cash flow or to cover itself. But if you're going out there hunting for a location that's going to deliver you positive cash flow, which is what most people do, then I see massive issues in that. And usually what people do is they'll get into a location early. That's their whole strategy. We'll get in before everyone else. We'll get cash flow, and then, everyone will come in and we'll get this huge amount of growth and all of a sudden transform into the next Sydney.
It's not the way it works.
Yeah, unfortunately not.
So you talk about manufacturing positive cash flow. You mentioned some ways to do that, which absolutely is right. How much is rising rates going to do the heavy lifting on turning properties from negative geared to property geared? Are they going up in lockstep with rising interest rates, or there's still a big disconnect there?
As in cash, the yields of properties?
The yields
are not keeping up with the interest rate increase. It's not a chance. Every time interest rate goes up by 0.5%, it costs me $50,000 a year on $10 million.
Yeah.
So
it's hard to make that up in rent raises, right?
It's not possible.
And now you see stuff coming out saying, they're trying to lock rents in for 2 years.
2%, yeah. I did a video on that the other day.
Yeah.
So what we say to clients is, because it doesn't matter what your income is, if you're a PAYG, you're generally capped on what you can earn inside of a firm. So you're going to hit a serviceability limit at some point in your journey. Some people hit it faster than others. So we want to concentrate on buying the best quality assets we can buy for our money. We focus on quality, not quantity. I'd much rather have 3 or 4 really good quality assets, no headaches, easy to manage, strong capital growth, than have 8 to 10 assets in inferior locations, to be politically correct. And then once you hit that serviceability limit, it's about going back to those existing assets that have grown to see what you can do to manufacture, cash flow. It's much easier to put a granny flat on a property, for example, or a second dwelling on a property after you've built out the portfolio than, doing it as you go, because you're eating into your servicing.
Right? We spoke about backfilling. So imperfect action. Okay, I'll get this now. I can backfill that in 2, 3, 4 years' time, 5 years' time. I can put a granite flat, but as long as the inherent initial asset is good that you can actually build a granite flat on, you've got to make that buying decision at the front time. If you make the wrong call, then you can't do anything. You're lumbered or you've got to encumber it with a property that's not going to work for you.
And a lot of people make the mistake of going, I want to find a property that has granny flat potential, and that's their main focus. So all of a sudden they're going into inferior locations or looking at properties that are not ideal just to have that granny flat potential.
Yeah.
We focus on fundamentals of location, owner-occupier appeal and scarcity, and then go, well, can we add a granny flat? It's not our main strategy, but if we can, great.
Upside.
If not, who cares?
It's okay.
Yeah.
You can sell the asset to someone else in time. And there's nothing wrong going back through your portfolio and shuffling the deck, right? Like a lot of podcasts, a lot of people in property always talk about the acquisition side of property, but there's a point when you've been doing it a while where you need to go back and start maybe recycling assets, selling down assets, moving that capital elsewhere. When's the right time to do that, or is that all the time the right time to be doing that?
Yeah, I think in good markets is the right time to sell bad assets. Yep. So I made a mistake. The first property that I bought, the apartment in Coogee, been an awesome performer, but knowing what I know now, I wouldn't have bought it.
Okay.
Great location. Fundamentally it's okay, but small second bedroom, no parking. The street that it's on is a bus route. So things like that. I was 18 years old. I had no idea. Now I know the area like the back of my hand.
Yeah.
So I should have sold that last year because I would have got a strong price for it. But the valuation on that property from the bank is actually stronger than what I'd sell it for. So I'm like, well, I'll just cash out the money and go and spend it somewhere else.
Pretty cool.
Yeah. So for me to sell that now, it wouldn't make sense. Like the net number would not be worth it. It'll probably come up negative by the time I pay an agent, capital gains
All that
tax.
sort of stuff.
Yeah. So I think a good time to get rid of average properties or properties that haven't performed that well is in a really strong marketplace, because anything sells. In marketplaces like we're in right now, if you've got a B or a C grade property, you're only selling that thing if someone feels like they're getting a bargain or a deal.
Yeah, and that's where a lot of buyers agents sort of hang around, right? Looking for those, because that's where you start manufacturing equity in those.
I'm not an advocate that hangs around for B and C grade assets. Like right now, I say to everyone, I was on the phone to a prospective client before I come in here, and I said, what you really want to focus on in this marketplace is notice what is selling and notice what is not selling. And the ones that are selling are the only ones you should be buying, right? Because are you looking for the right property or are you looking for a cheap property? Because cheap properties are easy to find right now. There's heaps of them out there. And if you compare it to what they would have sold for in January or November, heaps of them, 10, 15, 20% discount. But the good quality stock is still selling extremely well.
Yeah.
And you want to take notice of that, because there's a lot less of that selling than there is of the average stuff.
It's a good point. And by the way, what you're learning here is a masterclass in how to sort of look at and consider different strategies available to you. And Jack has a particular view of it, and it's very informed, to be fair. But what is selling? So let's have a chat about that. We'll go to another break. Stay with us, everyone. Back in a moment.
Have you considered adding Perth property to your portfolio? Momentum Wealth has experts on the ground to help you find the best opportunities in WA. They'll take care of everything from shortlisting and inspecting properties right through to negotiating the best deal on your behalf. And when it comes to managing your property, they have experts for that too. Contact their award-winning team today at momentumwealth.com.au and get your advantage in Perth's property market.
Welcome back, Phil Tarrant and Jack Henderson. We're having a chat around how to actually capitalise on this particular market. There's a lot of strategy and tactics available to you. But you said right now you're getting discounts 15 to 20%. The best time to sell not a dud property, but a poorly performing or a property that's probably done its course for you is in markets which are strong. We're not in that market right now. So if you're sitting on that stuff right now and you can hold on to it, sit around and wait, because good times will come again.
Exactly.
But you said that right now good properties are selling. They're selling well still. Your B and C grade properties are the stuff that you're going to pick up cheap, and you can actually hover around and try and get your bargain there, or get a really good deal, and you can do stuff with it and put some sweat equity and build it. But you're talking about the A grade assets right now. What are they? What do they look like? Where's that competition?
Well, they're different in every location, right? What an A grade property looks like in Brisbane is very different to what it looks like in Sydney, is very different to what it looks like in Melbourne and Adelaide. So it's understanding the area you're investing into.
Let's go through it. So what's an A grade in Sydney look like? Which is selling?
So if you're in the inner west, for example, which is an area that we buy in, you're looking for a terrace or a semi on a quiet street with good sunlight, that has parking, that has good width, that's close to one of the villages. It's a big area.
What are you paying?
Depends. Anywhere from 1.5 to 2 million.
Yeah.
Eastern suburbs, for example, you're probably looking at an apartment. If you're looking for, investment stock, just buy and hold. Same thing. You're looking for boutique blocks, north facing, good floor plans, walk-ups, lock-up garage, quiet street, uninterrupted aspect or views. Same thing, you're paying 1 to 1.5 or something like that. I'm about to buy one in Bronte today for probably like 155. If you're looking in, say, the Hills area for a freestanding house, you can probably pick something up for, again, 1 to 1.5. You want to be in school catchments are super important in locations like that. So what's the best school catchment in that area? You're looking for level land. You're looking for no irregular shaped blocks. Yep. Big reason for this is the demographic of people out there, right? A lot of Indians, background, Chinese background. You need to understand that. Same as the North Shore. Is having the number 4 in the address important? In some areas it can be. In Brisbane, you want to be and again, distance is super important. 15 Ks in Sydney is a lot shorter distance than it is in Brisbane, because we have a higher, density and 15 Ks isn't as much. Whereas in Brisbane, 15 Ks is a lot, because we don't have the population up there. We don't have the urban sprawl up there. So you want to be within 5 Ks of Brisbane CBD. You don't want to be buying apartments in Brisbane. You want to make sure you're only buying houses, because that's what 80+% of the demographic want to live in.
And what are you getting there? You spoke about in a city of Sydney, it's like terraces and stuff. What's the equivalent of that in Brizzy? Is it terrace housing?
No, like your workers' cottages. Your Queenslanders, again, they're timeless. Yeah. Huge amount of scarcity to those. You want to be looking for large parcels of land, same thing, north-facing rears, rear lane access, something that you can manufacture growth to and add value to, but still has the fundamentals and the character features. And then you go to Melbourne, and again, it's very different. Am I investing 30 or 40 Ks out in, greenfield locations? Probably not, because there's an abundance of land. And in this marketplace, when there isn't as many buyers, that's when you start to see an oversupply and developers starting to cut back on their pre-sales and how much property's actually selling for.
Yeah.
So you want to be, in the inner ring of Melbourne, places like Port Melbourne, for example, where they're villages, you can walk places, Torrance title properties, not apartments. Now I was speaking to someone the other day, bought an apartment in St Kilda. Pretty good location, wrong block, wrong apartment, one better, no parking.
Yeah.
Good yield at the time, still good. I think it was a 5.8% yield right now. Just gone backwards. He's in almost negative equity if he didn't put in the 20% deposit. So right area, wrong asset type.
Yeah, it's a good point. So just to finish up, hypothetical, so I rock up with a deposit and, pre-approval. So I got 1.5 to 1.7 million bucks and I go, Jack, I want you to find me a good asset. Where would you start with that, as in Phil Tarrant? What would be the process of working out where to buy if I've got that sort of budget?
Yeah, so the first thing is understanding where you're at in your investing journey, right? Like if you've got 6 properties behind you and, you don't need anything you can manufacture growth to, you want to buy and hold, you want strong growth, and you want to, a stress-free asset, then it's going to look very, very different in comparison to if you're a first-time investor, for example, who's got no assets behind them. But if you've got $1.5 million to spend, I would say we're buying in Sydney for sure. Obviously we buy a lot in Newcastle as well. Yep. Another very, very strong market.
Nuts at the moment.
Yeah, and it has done for 20 years, right?
Yeah.
Like it's just becoming known now because of properties in the media every second day.
Yeah.
But Newcastle's an area that's performed for the last 30 years, gone through huge gentrification, huge government infrastructure spend, and you're 2 hours from Sydney and you're one of the largest populations in Australia. And you can get in up there for somewhere between 700 to 1.2.
And you can fly directly from Williamtown Airport to Bali, right?
Mate.
And, internationally.
Straight to Bali.
Straight to Bali.
But yeah, like it all depends on where that investor is in their journey, and something that I always talk about is you need to get the foundation right first before you start thinking about, let's buy something to develop or let's buy something we can, split. That's like none of that stuff matters if you buy the wrong asset. So it's about getting a really good foundation portfolio. And then once you've built that, you can start going into some high risk, high reward assets.
Yeah. So the answer there is for me is it's horses for courses, right?
Yeah, exactly.
What's right for me is probably wrong for other people, and what's wrong for other people is probably right for me.
Yeah.
Much like a negatively geared property for me might be positively geared for someone else. It's, and property investing is as unique as a fingerprint, right? Everyone's made up differently. And I guess your job is to craft the right strategy so people are buying the right asset at the right time, not just for today, but for the future, right?
Yeah, exactly.
That's the secret sauce.
I think one of the things I always say to people is, if you look at most Australians own or occupy homes, especially on the eastern seaboard of Australia, they've done okay out of them because they buy emotionally. Most people, when they invest, they don't do that well. So if most people just went and bought a second owner-occupier home, they'd retire much better off than,
True.
thought they would.
Yeah.
Because most people retire on their owner-occupier home.
Yeah, it's a really good point. I haven't really thought of it framed that way.
So if you say just go buy exactly what you'd buy for yourself again, put a tenant in it and come back in 50 years' time, most people will probably retire with, 3 times the net wealth that they would if they try to invest.
Or you could sell it and give money to your kids so they can keep going on their property journey.
Yeah, that's right.
That's cool. Mate, really informed commentary. Thanks so much for coming in, mate. If anyone wants to have a yarn with you, like what you're saying, what's the best way to reach out to you and the team?
Mate, henderson.com.au. Make use of that domain.
Just go henderson.com.au
and then Instagram, TikTok, Facebook, everything else.
All over the joint. What's your handle on the social medias?
Jack C. Henderson, C for Charles.
All right, there you go. Thanks for coming on, mate. Look, I've spoken to Jack a fair bit. You can go and tune into a whole bunch of our different discussions, and they've got a very similar flavour and upbeat sort of tone to this. We've known each other for many years, so it's been a real privilege for me watching Jack's journey as a property investor, but also now supporting Australian property investors with Henderson Advocacy. You can check that out, smartpropertyinvestment.com.au. At social media, we're Smart Property HQ.
What's the H stand for?
I don't know. Headquarters, mate. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.